Welcome to another edition of the March to a Million podcast with your host, Greg DuPont. I'm RJ Malik, producer of the podcast. Greg, you've got a guest with you today. So why don't you introduce your guest and tell us what you'll be talking about on this edition of March to a Million?
Absolutely. Thank you, RJ. Yeah, today my guest is Jacob Brigati. He is a premium financing consultant with Simplicity UFC. And we're going to talk about this tool that many people don't know about and how it can make what seems to be very expensive insurance affordable for many, specifically your business owners or people that are highly leveraged, those type of things. So, Jacob, welcome to the show, and I look forward to our conversation here today.
Awesome, Greg, and thanks for having me.
So, Jacob, a lot of the listeners to my program are attorneys or other high-end financial advisors that, may not really understand the leverage and the power that comes with premium financing. And so, if we could you just kind of start by giving me a little bit of background on what this is all about, and then we'll kind of dig in from there?
Yeah, so Greg, to that point, premium financing is a strategy where clients are trying to create liquidity in their estate. Now, the way we position this is we have big banks that will fund insurance in an irrevocable trust, right? Completely estate tax free and income tax free on the back end. And the biggest selling point for attorneys and financial advisors and even clients is the money that the bank is putting in does not go towards their gift, right? Because it's a loan coming from a bank directly to the insurance in the irrevocable trust. So the only money that's counting towards a gift, which is a big part of the client's estate planning, is the money the client's paying as a partial interest payment. So they're creating big liquidity with bank leverage, right? So it's a big estate planning strategy and ploy that we're using for these high net worth families that are over, the $20 million estate limit, or 30 million right now, 15 million for each husband and wife. If we look at that unified tax credit, that's growing by the 2.25% a year, 2.24%. So that's one of the kind of main reasons that we're looking at it. Does that make sense?
Yeah. So I've had many clients over the years that have come in with large concentrated positions and things that they just can't figure out how to get liquid. And one of the starting points that I'd like for you to address is, if we are dealing with people, in their later years, a lot of people think that this is just not an opportunity anymore. I may be sitting here with looking down the barrel of a $10 million estate tax, and all you can do is suck it up. So how can we kind of break through that noise and help people understand that there are solutions outside of typical high premium solutions, and that we are not limited necessarily by age on some of these things?
Yeah, so I think it's all about the need for the insurance, right? If you have someone that states at, let's say, 30 million that's continually growing and the tax is going to be $10 million, like you said, if they live till life expectancy at 80 or 85 years old, and the numbers make sense on the financing side, as long as they're healthy, right? Usually we try and focus to like under 65 years old, but if we can make the numbers work and it looks better than a traditional insurance policy where they're paying the full premium. Like, for example, I'll give you a quick case study for a client that we have here in Tampa. It's two brothers, one's 58 and the other one's 63. And for the 63-year-old, it made a lot of sense because he was worth 25 million and his estate was going to continue to grow. And for him in specific, he had a friend where he passed away and all of his loans were called because the covenants of his loans said if something happened to him, his loans were all going to be called. So that was the real need for the insurance for him there, right? So I think it's finding that need and kind of pinpointing that and then kind of rolling with the punches there and structuring it, where it's all an efficiently funded policy outside of their estate. And that's what we're doing for all of our clients.
Oh, that's an interesting example there, Jacob. It just brings back the memories, of sitting with clients that have built their wealth with real estate, and they're very committed to that. And we wake up they're in their 50s, and not only do they have a portfolio of several $1,000,000 of real estate, but they got obligations that are half of that because they're leveraged. That's the way that they operate. So what I'm hearing from you is, in a situation like that, let's say we've got somebody in their mid-50s and they have a $40 million real estate portfolio, but they got $20 million of loans against it, and they want to try to have it stay intact for their next generation if anything were to happen to them. That's where services like yours could come in and show them a path that even though this thing is a large death benefit, the actual out-of-pocket cost is nowhere near what they think it might be.
Yeah. And to that point, it all comes down to some of these loans have personal guarantees tied to them, which means the banks can call those loans, right? And that's what happened in this client situation. But what gives the bank some peace of mind, and it's not every time, right? But if you have $10 million of insurance that would be used to cover a portion of those loans, the bank is a little more at ease, right? Whether it's, any type of insurance, but this is going to be an efficient way of funding it.
Yeah. So with that, when I was practicing law solely before I started being part of this movement and doing both of things, I had a bad impression of premium financing, and I've seen enough over the years to see when insurance goes wrong. Can you help my listeners that are estate planning attorneys that are they may be wary of this because of some of the stories that they've seen and heard, how your team, sets people up to win and protects against some of the problems that are out there with premium finance insurance.
Yeah, absolutely. And that's a question we get all the time, right? Because premium financing isn't a one-time sale. It's really, managing these clients, expectations and these policy reviews every single year for the next like 15, 20 years on. And that's what we have a renewal team of 5 people doing every single day. So what we do is we come up with these comparison performance reports, which is tracking how everything was sold to how we're doing every single year, both on the loan side and the performance side. And when we show our projections originally, we're showing like 6.6% on the earnings side. And when we show our loan rates right now, we're showing our rates going up to like 7.25% by year 8 and 9. When the Fed dot plot, which is a survey of all the federal governors, they think the rates are going to be at like 3 to 3.5, which is the FFR rate, which is what the banks are paying for the money. And they actually charge like a point to a point and a half above that, where they're saying the median rate in like 3 years is going to be 4.5 to 5%. We're showing over 7. So we're being, very conservative in our projections. And right now, what we're also showing, Greg, in our illustrations is 0% returns the first 2 years. And then on the collateral side, we actually show a third zero. So we're basically showing 0% returns on the collateral side and 2 on the earnings side. So we think we're covering all of our bases there, along with reviewing everything every single year to show them how they're tracking. Because we would rather under promise and then over deliver on the back end, where now we have a happy customer where they're saying, oh, we didn't show you 8% returns. We showed you 6.5 or 6.6. And we dialed the returns down by putting in the zeros. Does that make sense?
Yeah, I think that's a point worth underscoring. So you're being incredibly conservative in your structure, in the way that you are making the promises, the commitments. You're being very, very conservative on that, and as opposed to some Tom, Dick, and Harry out there in the insurance world that is being very aggressive, showing what their rate of return is going to be. You're going the other direction because your tool is so strong, and you've got these third parties that are involved as well. So you've got all these fiduciary relationships, to use that term somewhat loosely, that are involved. So you guys are playing it as close to the vest as possible instead of going out on the limb on any projections.
Yeah, definitely. We would rather have a happy customer on the back end and show them something that doesn't look as great up front and it to perform way better And I'll tell you, we have these reports that we put together every single year, and we're either tracking what we showed or doing better on, I would say, I mean, all of my cases that I've done is either tracking or doing better than what I showed because of those conservative projections.
I want to kind of come back to structurally how you guys operate, because you're part of the Simplicity universe, and so am I, and all that. And so if I've got a client that fits the profile, then I invite you in. We co-work the case, and you make sure that the I's are dotted, the T's are crossed, and that I don't step in it.
Yeah. I mean, listen, what we do is we bridge the gap between the insurance company, the bank, and you to the client. That's where we come into play. We understand all the insurance products. We look at every insurance company in the market, and then same thing on the banking side, where we're looking at all these different banks, um, where we're coming up with the best solution for the client based on their situation, because there's not a one size fits all. It really comes down to every client situation is a little different, and we're going to be agnostic to what we're showing, just like an advisor on the managed money side, right? Every client's going to be a little different. We're doing the same thing on the insurance side, where we're backing into the need for this, for the solution to solve the problem.
So just to take that one step further and further elaborate on it, because many of the members of the Wealth Solutions Network are full-time lawyers and kind of part-time financial advisors. Okay, through our process and procedures, we give them confidence to step into that role. But you're talking about high net worth people, and an attorney that does not necessarily know all of the ins and outs of insurance. But what I'm gathering from you, Jacob, and I'm throwing this out there, is you give us the confidence that your team is able to come in and give this client that the attorney has a long time relationship with, give him the highest level of care while the attorney stays in as the liaison as part of the WSN approach. But everything from making sure that the product selection is correct, that the whole lending mechanism is correct, to the most important part, the ongoing management follow-up. This is what your team provides. Am I getting that right?
Yeah, that's what we're bringing to the table for hundreds of advisors, attorneys, CPAs, across the country, and even family office CFOs come to us that want to implement some of these strategies for their families.
So we talked about a couple of specific use cases, but let's have some creative things that people may not be thinking of. So it's easy to come up with the idea of, okay, I've got a leveraged estate plan kind of situation, estate tax kind of situation. But what are some of the other things that premium finance insurance may be attractive for people to use, that people just are not thinking about? Can you give me some other examples?
Yeah, great question. And I get this all the time because there's so many different fits for it. It's not like I said earlier, it's not a one size fits all on the client side. Premium financing is also multi-purpose, where you can use it for buy-sell agreements for creating liquidity within a business. You can also use it for asset equalization. I think that's one of the main tools for premium financing, because we always talk about some of these real estate developers and business owners where one of their children is in the business and one or two are out of the business. And if the business is worth 15, $20 million, there's no way of equalizing those assets other than creating some type of liquidity. And that's what, this insurance vehicle can do, where they're going to pull some cash flow out of the business to leave to those two kids after something happens to the breadwinner and the patriarch, in a sense, or matriarch, whatever, whoever's owning the business in that case. So I think that's one of the biggest things, where if the business is worth 15 million, you need to create 15 million of liquidity for the two other kids, and the insurance can do that.
What about retirement income planning? How does it fit into that tool?
Yeah, and you can absolutely use this. We'll structure these plans where you can take out income in like 15 or 20 years, depending on how everything's structured, where we'll do a death benefit reduction. after the funding to lower the cost, because in that case, you'd want to lower every cost we can on the insurance side to maximize the income. Now, like for some of our clients, for example, I have them come to me all the time and they're like, well, maybe I don't want to lower the death benefit. And we just have to earn a little more returns on that, or we could keep the death benefit higher and then take some income out. So these plans are always flexible, and we don't need to decide what we're doing, whether it's an estate plan or an income plan, after year 10. So it's the same exact plan going into it. And then after year 10, we can decide if we want to lower anything or we want to keep it as is and let it ride out. But yes, we can absolutely do that.
What about things like Roth conversion and those kind of places where taxes have to be paid, but people don't like to pay the taxes?
So we can absolutely structure something like that too. I mean, I'll give you another case study that we just did, very similar to kind of what you're talking about, where it's a very high net worth family, and what they were trying to do was get some assets outside of their estate because they had money in an IRA. Now, what we did was we took the IRA money and we're putting it into, well, they're transferring it from that to their account, obviously working with the proper attorneys and the tax CPAs and all that for this client's specific situation. And they transferred that from their IRA to their account. Now they moved that money to an IUL. Okay. And then after that, now they're paying the taxes from their estate. So they're getting the IRA assets outside of their estate using their unified tax credit, and they're shrinking their estate by paying the taxes from the assets in their estate and their brokerage account. So that you see what I'm saying, where they're transferring some outside of their estate and they're shrinking their actual estate assets. So there's different ways we can structure this where, I mean, every client situation is a little different, but we come up with creative solutions, all with reports and data driven. So it's always going to be the absolute best solution for the client. And we actually presented the final plan on Friday to the client. It was a few days ago, and they loved it. And they're finalizing everything with the CPA and the tax, how we're structuring everything on the tax side and all that.
Fantastic. So after that client says, "Yeah, that this plan is great," what's it look like then? So, we typically with insurance we have underwriting, all that kind of stuff. Is there underwriting involved with the financial part as well? What's the next step in the process look like for that client that said, "I like this plan"?
Yeah, so for a typical client that's applying, we're going to go ahead and send out a HIPAA, like an application, just requesting for us to order medical records. We're going to need some specific information from them, like net worth, income, and all the different, generic questions to send off to the insurance company. Then there's something real easy. They just take your blood, just an exam where a examiner comes to their house, does all that. Then we go through like the financial underwriting along with the medical underwriting. So we're hitting those processes simultaneously. So once we have a medical offer, we're also approved on the financial side. Then we're talking to the client pretty much, I would say, every few days throughout this process, because we're trying to keep in contact with them and make sure they understand how we're tracking. I would say 3-4 days, sometimes it's a little over a week, just depending on travel and all that with the client. But we're keeping in contact with them every step of the way and updating them as it goes on. So once we're financially and medically approved, we'll set up some calls just to review that, here's what we showed you originally, here's what we got approved for. And then we kind of finalize everything from there. But it's not, for us, it's going to be a in-depth process of explaining everything, explaining the risks, right? We're going to go into the few things on the collateral side, or the risk, like collateral risk, where, you're going to need to put up some outside collateral for these premium financing transactions. And then we'll also touch on the performance risk, right? None of this stuff we're saying is 100% guaranteed, but we think we're covering our risk by being very conservative up front. And we're going into eyes wide open with all these clients so they understand everything from A to Z.
Can you give our listeners some guidelines for what the financial underwriting looks like on that?
Yeah, for a traditional premium financing case, we're looking for, a net worth of 10 million or more, and an income of around 200,000 plus. Because when we're showing the 10 million, we're projecting their estate to continue to grow, where they're going to need some liquidity after something happens to them, and then there's also a need for some collateral. So we want them to be over 5 million, because that's when they start to get a little more cushion for the collateral side, to be able to put that up. So it's between, we would say, 30 years old and 60 years old, 65 on the high side there. That's worth like 10 million or more. And if they have clients that are worth $1 million or more, we also have a no collateral premium financing strategy that we can explain a little more about for like those smaller deals.
So with the ones where collateral is needed, can you relate liquid collateral versus illiquid collateral, real estate versus stocks, bonds, how that's looked at?
Yeah, so the collateral does need to be a little liquid, right? It's going to be, stocks, bonds, mutual funds. We could use money market CDs. We can use a letter of credit. That's a big one for some of my um, real estate guys, where they're using letters of credit because they have relationships with banks already. So some of these banks will give a line of credit on a property that's already free and clear, and then they could get a letter of credit on that line. I would say the easiest thing is going to be like a brokerage account, but not every client has that brokerage account set up. So we're all pretty flexible on that, but we like to get ahead of the collateral up front. So we say, hey, what does your estate look like? What are your assets broken down as, to try and get ahead of that number? And we're trying to always leave a cushion on the collateral side. So it's all super conservative. We never have any issues there.
What are the downsides? Other than need to have a good amount of assets to qualify for this, but what are the downsides on it?
Yeah, I would say the downside is, like you said, not everyone's going to qualify for it. That's the reason a lot of our clients aren't doing, or a lot of clients in specific aren't doing it, because they have to have the collateral there. That's the biggest hurdle for us, is the collateral, and clients having that either liquid or the ability to get the letter of credit. But if we get ahead of those two things, or that one thing, the collateral, it makes a lot of sense for the right client. Now, the other thing is they have to qualify medically. Not all of our clients will qualify for these policies medically. And, we try and get a standard or better on these financing policies, just to structure with the minimal cost for the client and the max cash value in the policy.
Does the amount of the death benefit affect the underwriting, the health underwriting? Is it any more stringent, or is it, if it's 100,000, 100 million, it's really the health is the health?
So I think some of the insurance companies do tighten up their requirements when the death benefit gets a little bigger, because it's getting more of a risk on their balance sheet, even though they're going to the reinsurers. There's certain, like, over 10 million, there's an EKG need for certain companies just on the medical side. But I think the way we package these up to the insurance companies, we make it real easy, where everything's done up front on the pre-underwriting side. And we have a full underwriting team here at Simplicity, just doing everything for us, where they're reviewing the records. Once we have a HIPAA, they'll review everything, and they can give us a direction of how we're tracking. I would say we just package everything up, and depending on the size of the deal, we do anywhere from $5 million deals to 100 million plus, and we don't have any issues.
Well, and I just want to underscore that as well, because again, this is what you guys do. So for the agent, WSN agent attorney, just brings you in your partnership, and you run it from there, and you pull out, the insurers, who's going to be a good fit for this client, et cetera, et cetera. And Jacob, I'm not sure how much you're allowed to share about this, but this is not your guys' first rodeo. Tell me a little bit about you guys' stature in the industry.
Yeah, so this is all I do, premium financing. We do some non-finance business, but our CEO Vince has been doing it for 43 years. He's one of the top guys in the whole industry. He's on the board at Allianz. He's on the board at Simplicity, so he's been doing it for a while, right? Where it always helps bringing him in on this, where it's he's bringing the experience, and he does both retail where he's dealing with the clients directly. So he understands that aspect. And he's also helping advisors like yourself, just educating the clients on here's how we structure this thing, all on the back end. So he's been doing it for a while. We probably have, a few $1 billion of loans on our books here at Simplicity UFC. And we've been doing it. We probably have 700 plus cases.
So, if you're an advisor with WSN, then, you get access to Jacob through me as a strategic partner of theirs. But Jacob, if the person who listens to this program isn't part of the WSN, just an attorney out there that happens to have a client that fits your perspective, how would they get in touch with you? What would be the best way to reach out to you?
Yeah, so my number is 727-390-4099. And my best email is firstname.lastname at simplicitygroup.com. And it's jacob.brigati@simplicitygroup.com.
RJ, you've been quietly in the background there, kind of soaking it all in. Is there any questions that were maybe jumping through your mind as Jacob and I were having our conversation?
No, you and Jacob covered it all. I mean, it made a lot of sense to me. So why don't you give your contact information, Greg?
So if anybody wants to reach out to learn more about WSN or our mission, the March to a Million, best way to start into my universe is going to www.gsdupont.com.
Awesome. Thank you so much. And if you've not subscribed to the March to a Million podcast, make sure you do that. If you know of an estate planning attorney, financial advisor, or a client who really needs this information, please make sure you share this podcast with them. So for Greg DuPont, I'm RJ Malik, and we'll see you on the other side of the mic very soon.